Well, good morning. I think the seller is probably quite an appropriate place this morning, because after the events of 2018, I think many investors might felt that they struggle with a hangover. So the seller is quite an appropriate place. Let's just revisit a few trends that unfolded during 2018. I think if we look at investment performance, it is true to say that it was a very tough year for investors, not only in South Africa, but across the world. If you analyze the performance of the various asset classes, all the asset classes except cash gave a negative return. Global equities in dollar terms lost about 8% of their value. Bonds lost 3%. If you look at the performance of high-yield corporate bonds, they lost about 3% of their value. So there was, in fact, no place to hide. If you look at South Africa, cash gave a decent return in rand terms, but the South African equity market, unfortunately, lost about 8.5% of its value over the year. What is perhaps a bit more concerning, if you look at the performance of South African equities, is it is the fourth consecutive year where we had really pedestrian or negative performance for South African market. And I think it is true to say, if you look at the performance of asset classes in South Africa, over the last 4 years, investors, unfortunately, have not been rewarded for the risk that they've taken to invest in risky asset classes. And by risky asset classes, I mean equities and I mean property. Listed property last year gave a negative return of 25%, and over the last 3 years returned a negative 1.2%. The problem with these numbers are that many investors now question the normal financial laws, and those laws would normally dictate that given higher risk, that investors are entitled to expect a higher return. And this truism has now been questioned by many investors, and the risk is that they are taking their risky investments out of the market and invested in non-risk investments that will ultimately not give them the returns that they deserve over the longer term. Looking at the prospects of financial markets in 2019 and for this particular investment cycle, I think it is important that we just revisit some of the major economic trends that we think will dictate the behavior of investors. Some of these trends have already started in 2018. In 2018, it was quite clear to us that if you look at global economic growth, that the momentum is slowly but surely starting to come off in terms of economic growth. Many commentators might argue that a recession is quite imminent. We tend to differ with that view. We don't argue that activity will slow down, but we think that a number of indicators would suggest that it is unlikely for the global economy to go into recession in 2019. And there are a number of factors that would give us that indication. Firstly, if you look at inflation, there are very little signs that inflation will go out of control. If inflation stays within the 2–2.5% levels, it is unlikely for monetary authorities to act aggressively to try and cut inflation. And therefore, we think that monetary authorities will remain quite cautious when they decide to hike interest rates in this global cycle. So that is quite important. If you look at the employment market, we've seen the lowest unemployment rates almost in history in the United States. So the consumer in the States is likely to remain quite upbeat, and because it's such an important part of that cycle, it is unlikely that that consumer will suddenly disappear and allow the economy to drop into recession. Of course, the market is concerned about a few what we call tail risk. In other words, if I can rephrase tail risk, those risks that on the periphery are likely to cause a recession. Those risks are very well documented. The first thing is the problems that we have with global trade, and in particular, the trade war between the United States and China. At the moment, the two sets of authorities are in conversation with each other to try and come with a solution. We don't think that will necessarily put the world into recession. Secondly, we have Brexit. And as we speak again, negotiations are happening around Brexit and how the Brits are likely to take themselves out of the European Union. Of course, that will have economic implications. And finally, there are also some problems within Europe where an economy like Italy can easily go into recession and can cause some financial problems on the rest of the continent. Those are risks that we will continue to monitor, but our base case view is that those risks will ultimately not result in a recession. However, what we can say is that the economic cycle has now been ongoing, the upcycle has now been ongoing for about 10 years. And it is just natural to expect the activity to slow, and therefore it is likely to have an impact on the strength of the profit cycle, not only in the US, but in the rest of the world. So let's talk about the financial markets. As I said, I think the risk is starting to build in terms of economic activity, and therefore investors is likely to take that on board when they decide on how they're going to invest in markets. We've had a 10-year bull market for American equities in particular, and for the world. It was correct to have an aggressive position there. We think now is not the time to be aggressive. That is beyond us. Why do we say that? Firstly, profits are likely to slow. Secondly, and very importantly, the valuation of these shares reflect a lot of good news. We by no means saying that the market is in bubble territory. In other words, that we expect a major collapse in financial shares across the world. We are simply saying that we've got to recalibrate in terms of our performance expectations, and the very good performance that we've experienced over this particular 10-year cycle is unlikely to repeat itself for global equities over the next 3 years. If you look at global bonds, those bond yields in America are currently trading around 3.8%. Because inflation is not really a threat, it is hard to expect those bond yields to kick up significantly. On the other hand, the market is probably correctly priced. So if we think the market is correctly priced, it would be probable to get a return of around about 3% in dollar terms in this particular asset class. Let's talk about South Africa. It would be true to say that South Africa was a major disappointment, not only in terms of the performance that was generated across a wide range of assets, but also in terms of the economic performance. The strong structural performance that we've seen in the period from 2003 to 2008 was not repeated. And we've actually gone backwards, and over the last 2 to 3 years, we were certainly caught in a low growth trap. It's very hard to see what will get us out of this very pedestrian growth cycle. And given the elections that is just around the corner and will probably happen in the second quarter of this year, it is unlikely for entrepreneurs in South Africa to make major investment decisions. So I think it would just be logical to expect more of the same in terms of the growth rate in South Africa. If we need to add a number to it, we think that the local economy can, in 2019, grow at a rate of about 1.2% to about 1.7%. The next thing is, what does it mean for the performance of fixed interest, of property, and of equities? Let's start with fixed interest. Cash will probably give you about 7.5% to 8% this year, and that brings us to government bonds. Although the bond yield is quite attractive, around about 9% if you buy a 10-year government bond, my major concern is that the fiscal situation in South Africa has deteriorated significantly over the last 10 years. So the risk associated with that quite attractive yield is very high for us. So despite the high yield, we would be unlikely to take an aggressive positive position on government bonds, as the risks are still pretty high. That brings us to equity, and equities are always close to our heart because we still have the view that over the longer term, if you want to grow your wealth in real terms, that is the asset class that you should look at. However, investors were materially disappointed with very poor performance over the last 4.5 years. And it is probably true to say that you can understand why they think they should find another alternative to produce inflation-beating returns over the longer term. My experience and our experience and analysis would indicate to lose patience right at the wrong time is probably the worst decision that investors can take. So despite the pedestrian outlook for economic growth, it is true to say that if you analyze the valuation of the South African equity market, that many of the shares that we look at are now trading at very, very low valuation levels. In other words, to put it in simple English, when you buy many South African shares at the moment, you buy a cheap asset. And cheap asset is probably the most important ingredient in the recipe to generate decent returns over the longer term. Despite the very pedestrian outlook, in this investment cycle, we think that South African equities might well reward investors for the risk that they take to expose themselves to a volatile asset class. For us, if I compare it to 3-4 years ago, it is quite easy for us from a bottom-up perspective. In other words, if you look at individual counters, to find shares that we would be likely to buy. So what we would suggest to clients, now is the last moment that you should think of reducing your exposure to equities. In fact, should the market go down further, we would view this as a very good buying opportunity for equities on longer term considerations. Quite often people ask us, what is your view for the next 12 months? I can give you an answer. Unfortunately, in the short term, and a 12-month period is a short term, investor sentiment can change significantly. And that, of course, will dictate the performance. What we can say with far more certainty is that in this investment cycle, and now we talk 3 to 5 years, we think that the prospects is quite good. And when we look at our normal prospective return matrix, it's just it's a matrix that we designed for ourselves where we look at the prospective investment performance based on what we think earnings could be generated by South African companies, and of course the rating that you associate with these companies. We think that equities can easily do 13% per annum over the next 5 years. If we sit with the inflation rate of around about 5%, and by the way, the Reserve Bank, it seems to us, now targets 4.5%, that gives you a significant real return. In other words, a significant return in excess of the inflation rate, which simply means that we think that in this particular investment cycle, equity should grow your wealth in real terms and ultimately provide the outcome that you deserve to sustain yourself at a period when you need these funds.